Equities are having a great start to the week with the S&P 500 up more than 1.6% on Monday. Here to discuss gold and stock moves is Gary Wagner, editor of thegoldforecast.com. Gary, what's driving equities higher on Monday? Are there particular events you're watching out for?
Well, I think that what we're witnessing is what we have seen over the last 3 weeks to a month, and that is the Federal Reserve's monetary policy. When you have interest rates at near zero, you have quantitative easing, meaning that they are infusing great amounts of liquidity to the tune of 120 billion per month. Companies can do things with that money. When it's so cheap to borrow money, they can expand, they can pivot in ways that they couldn't before, and pivot into parts of the industry that are more applicable to the days of this pandemic.
What strikes me as surprising is how much markets are rallying today, given how much uncertainty there is remaining with the political gridlock we're seeing with fiscal stimulus. Does that surprise you at all?
It does surprise me. My belief right now is it will be very difficult for the House and the Senate to come to some sort of an agreement and Trump sign off on some sort of fiscal stimulus prior to the elections. At the same time, what has been driving the economy and having it is contracted, but it is the Federal Reserve's monetary policy that has really kept the United States afloat, so to speak.
How are you interpreting this gridlock? Is it just political jockeying, or is there an economic incentive to stalling a stimulus package?
I think it's positioning. I think that when Trump came out and said he would not negotiate last week and then backtracked on it, what he said was he was willing to talk about certain points, and those were the points that he wanted passed in the first place, which is the $600 in addition to the unemployment, and to have each citizen get $1,200. What he doesn't want to do is to fund the states because of his belief that some states shouldn't get it. And so I think that he's basically trying to position himself in a way to make a better deal. However, the outcome seems to be that you've got a great stalemate being built where you've got two sides and they are not moving in terms of the key points that they want passed in this aid package.
What do you think the markets are pricing in, Gary? Are investors pricing in a certainty of not getting stimulus before the election, or is there a possibility we're still going to get some sort of package before November?
Well, when we talk about the markets, let's divide that into precious metals and equities. In terms of precious metals, they are really relying, a big boost for the price of gold or the price of silver would come with fiscal stimulus, because realize, even though the Fed is doing quantitative easing, they're actually investing in things, in assets, but that doesn't change the budget deficit. The deficit changes if we do fiscal stimulus rather than monetary stimulus. And that is what really I think people are waiting for.
Now, moving on to monetary stimulus, do you see any updates with the Federal Reserve's policy going into the election? We saw last week when Trump announced that he would not cooperate. Well, first, he did not want to cooperate with the Democrats. That Jerome Powell, chair of the Fed, immediately said that, no, we really do need some sort of fiscal stimulus. So I think they're just run out of ammo here. Isn't that true?
Precisely right. I think that the Fed has done a brilliant job, first of all. And second of all, they've done everything they can. They're not going to go, I don't believe that they will go to negative rates. And right now, the Fed funds rates are between 0 and 0.25%. So it makes money very easy to borrow. When they build their asset sheet by quantitative easing, what they're doing is they're making money very cheap to borrow, and then they're flooding the markets with lots of money available to corporations. And so I think that it is fiscal stimulus that is greatly needed. I think the Fed has done everything they can possibly do to help stop the contraction of the economy.
So what you're basically saying, Gary, if I understand correctly, is that the Federal Reserve has run out of options. On the fiscal side, it's unlikely we'll get a package before the election. Why are risk assets still going up? Why are people still feeling optimistic about risk?
Well, I think that when you're looking at the equities themselves, what is happening is they are being greatly affected by the Fed's monetary policy. The fiscal stimulus is going to help the individuals, but companies don't gain any great advantage by that. They gain advantage when they have low interest rates and easy money to borrow. And so that's why I think you see equities continue to rise, one. Secondly, with interest rates as low as they are, most people are very reluctant to put money into either bonds or savings account because the yield is so small. And then they see the stock market moving. And so they're taking money that they might have saved if they had any kind of decent return or put into bonds, and they simply they're putting the money where they think it will work best. Liquidity theory is basically that money moves to where it can grow the easiest. And that, I believe, is what we're seeing.
If the markets don't seem to be worried about rising COVID cases, and they don't seem to be fazed by the political gridlock regarding the fiscal stimulus, and they don't seem to be fazed at all by the fact that Jerome Powell has blatantly said that he's basically run out of options at this point, what could possibly bring down equities?
The key is people are still spending money. They're spending money on different things, but they are spending money. If you spend more time at home, you've got things like Netflix, any of the video services, any of the home delivery services, restaurants. At least here, we don't have any restaurants where you can sit, but the takeout and the Uber and the different ways you can have it delivered are doing extremely well. So what I believe we're seeing is certain segments of the economy actually doing exceedingly well due to the current crisis.
So what additional risks are you watching for right now, Gary?
Right now, in terms of risks, I want to see what the dollar does. Because with the uncertainty regarding the presidential election, with the fact that the stocks have moved so high and at some point could go into a correction as they did a little while ago, that the dollar could be adversely affected. What I found was odd was last time the U.S. equities came down, the safe haven asset of choice became the dollar over gold. And that was something that we haven't seen in a while. Now, it was short-lived, but nonetheless, we saw the dollar gain strength due to the safe haven aspect of the dollar. And so my real concern is whether the dollar will hold steady or we will see a great decline depending on the outcome of the election and depending on how the COVID epidemic, so to speak, pandemic, continues to grow.
Okay, so Gary, just on that topic, the U.S. dollar index has been trending down in the last week. What are the key support and resistance levels that you're looking out for the DXY?
And traders, we're looking at a simple line chart, this representing the U.S. dollar on the bottom and gold futures on the top. And we certainly see that there has been an inverse relationship where we saw dollar weakness, which is right here. We definitely saw gold strength. When gold tended to top out, which was here at the all-time record high around 2088, we saw the dollar begin to gain strength once again. And at the same time, we saw gold begin to move down. Now, most recently, in terms of activity, we've got an uptick in gold and again a downtick in the U.S. dollar. That tells me that the inverse correlation between the dollar and gold continue to remain in effect. In terms of support and resistance levels that we currently see for gold, right now we are trading at 1928.80. And the key level of about 1920, and that is this area right here, was the former all-time record high. That came in approximately the middle of 2011. I believe that that is now a strong area of support. The next level below that would be about 1880, and I am basing it on a series of lows that we saw that came into the market right in this area here.
So we know that there's a strong inverse correlation between the U.S. dollar and gold. My first question is, does this negative correlation still hold right now? And second, given the weakness of the dollar and your outlook, where do you think gold is headed next? What are the key support and resistance levels for the yellow metal you're looking out for?
In terms of different resistance levels that we are currently looking at, the primary level that we are right at is 1941. and that represents the 23% Fibonacci retracement. It is a long data set starting from the lows that we saw back in March to the new all-time record high at 2,088. Above that, we do have a band that comes in roughly at 1970, and then of course the brass ring remains a close effectively above $2,000 per ounce.
Gary, thanks very much for coming on the show today. I appreciate your thoughts. And thank you for watching Kitco News. If you enjoyed these insights from Gary Wagner, hit the like and subscribe button on YouTube and comment down below where you think gold and the dollar are headed next. I'm David Lynn. Stay tuned for more.